Hi, this is Matt Amberson, principal of ORATS, and today we're going to look at using the ORATS scanner to buy wings in order to minimize risk of our portfolio due to large moves. So the main thing that we want to do is find options that have the most, what we might call bang for their buck. Low price, but relatively high probability of reaching the strike, of making money on these wings. So how can we do that? Well, we could use the ORAT scanner to find relatively low priced options with a high delta, and we'll use criteria such as a reachability index. And let's look at what that reachability index means. We'll go down to the option criteria and we'll mouse over the information button here. And reachability index is the stock price range over the same amount of days out as the current days to expiration of the option in question, and how many times it would have reached that difference between the strike and the current option or the current stock price, and adding the option premium to that as well. So we're basically saying how many times we make money on this, or the range over the past number of days to expiration as a ratio over the strike divided minus the underlying. We're also going to look at, while we're here, the call or put away percentage. And this is the number of times that the stock would have been profitable, basically. So it'll be something like, for these types of options, with maybe average delta of 15, it might be right around 15. So let's set up this scan and see what our results are. So we want a price. I have the price with a maximum of $1, and I'm also going to score this. Now, scoring adds up the different criteria that you're looking at and measures the standard deviation, or how well each one of these matches up, and then we could add the standard deviations together. It's a way of kind of weighting the different criteria that you want to score. So we'll click that on. We'll go to days to expiration. I want 0 to 200. The absolute delta. Absolute means we can see both calls and puts. Calls have positive deltas, puts have negative deltas. So an absolute delta of 3 to 20 will get us the out of the money of both the calls and the puts. We're going to see the score. Here's the reachability index. I've set the minimum to 1. And I'm also looking for the highest reachability index and the highest delta. Delta could sometimes be thought of as the percentage probability of the stock reaching the strike. Again, the delta could sometimes be thought of as the percentage probability of the stock reaching the strike. Much like the call or put away percentage over the last 4 years, that's the percent of time that it had reached the strike plus the premium. So we set that as a minimum of 15, so that's 15%. So that's actually kind of matches up with what our average delta is going to be. And then I've added the leg ask volatility just to see what we would be paying for a point of reference. And then I've added price of the option, leg 1 priced divided by the strike. And I want the lowest price divided by the strike. Okay, so let's go ahead and run the scan. And what will be returned are the options that match our criteria the best and have the highest scores. Okay, so here's CCE. It's buying the June 30 call, 58 days to expiration. We're paying 10 cents for it, relatively low price, not too far to go. The stock's 28.05. Got a very high score of 12 standard deviations from the mean on average, because the reachability is very high. We could look at a graph of CCE and we could kind of see why the reachability index is so great. Again, the reachability index is the stock range divided by the difference between the current stock price and the strike. CCE had a range of 20 to, what was that, 28, just in that one kind of gap move over the last 2 months. So the ask implied is 17, and the price divided by the strike, or 0.1 divided by 30, is 33%. And these are the other options that match our criteria with descending sorted by scores. So again, what we've done here is tried to identify options with the biggest bang for the buck, paying a low price for wings, with stocks that we think have a decent chance at reaching the strike, and we chose those by the current reachability index and kind of the longer term call away percentage, which is again kind of a rolling profitability index and how many times that was profitable. And we also weighted we wanted the highest delta with the lowest price. So all those together gave us what we hope are options which with the best probability with the lowest price. So thanks for your time. Again, this is Matt at ORATS, Matt Amberson, and thanks for your interest in ORATS.